Hello everyone, my name is Roziana. My name 22104268898. I am from class Accounting D and I will reading chapter 4. Chapter 4 Financial Statement Learning Outcome. After studying this chapter, students are excited to be able to first explain the meaning of financial statements, second, differentiate and classify the types of assets and liabilities, third, explain the form of financial statement, fourth, understand the basis and purpose of financial statement, develop financial report formats. The definition of financial statement. The figure 3.1 both defines the financial statement of the collection. Financial statements are a collection of summary level reports about an organization's financial results, financial position, and cash flows. They are useful for the following reasons. First, to determine the ability of a business to generate cash and the share and use of the cash. Second, to determine whether a business has the capability to pay back its debts. Third, to track financial results on a trend line to spot any alarming profitability issues. Fourth, to derive financial rations from the statement that can indicate the condition of the business. Fifth, to investigate the data of certain business transactions as outlined in the disclosure that accompany the statements. The standard content of a set of financial statements are balance sheet, showing the entity assets, liabilities, and shareholder equity as of the record date. It does not show information that covers a span of time. Income statement, showing the result of the entity operation and financial activities for the reporting period. It includes revenues, expenses, gains, and losses. Statement of cash flow, showing change in the entity cash flow during the reporting period. Supplementary notes, including explanation of various activities, additional detail on some account and other items as mandated by the applicable accounting framework, such as GAAP or IFRS. If a business plans to use financial statement to assign user or such as investor or lenders, the financial statement shall be formatted in accordance with one of the major accounting frameworks. These frameworks allow for some level in how financial statements can be structured, so statements issued by different fields even in the same industry are likely to have somewhat different references. Financial statements that are being issued to outside parties may be audited to verify their accuracy and fairness of presentation. If financial statements are issued strictly for internal use, they are not guidelines other than common use for how the statements are to be presented. At the most minimal level, a business is expected to issue an income statement and balance sheet to document its monthly result and ending financial condition. The full set of financial statement is expected when a business is reporting the result for a full fiscal year or when a publicly held business is reporting the result of its fiscal quarters. Classification of asset, debt, and capital. The composition of asset and liability in the balance sheet is as follows: asset, current asset, long-term investments or investment, tangible fixed asset or fixed asset, intangible asset or intangible asset, and other asset. Liability and owner equity. Liabilities: current liabilities, owner income, long-term debt or long-term debt, other debt or other liabilities. Owner equity or capital, fight in capital or capital shock, agio or disagio or agio or disagio capital shock. Receiver, retained earnings. Assets. Assets are future economic benefits that are expected to be received by a business entity as a result of past transaction. Assets have two main properties. Fear, having the possibility of future benefit in the form of the ability or either alone or in combination with other assets to contribute to cash inflow in the future either declaration of indirectly. Second, a certain business entity can be obtained benefit and monitor this benefit. Third, transaction that cause the company right to obtain and supervise the benefit have occurred. Current assets. Current assets are cash and other assets or short that are expected to be realized into cash or sold or consumed during the normal business cycle of the company or within 1 year. Look the figure 3.6 below. The elements included in the category of current assets are: first, cash is available for business now, an element that can be likened to cash, for example, checks, money order, and water. Second, inventory of merchandise, raw material, work in process, business goods, auxiliary material, and material in spare parts used in the maintenance of store and machinery. Third, vegetables and non-vegetables. Fourth, vegetables for employees, subsidiaries, and other parties if achieved within 1 year. Fifth, installment vegetables and installment non-vegetables if they are common in trade and will be repaid within 1 year. 6. Marketable securities which are short-term investment. 7. Costs paid in advance such as insurance, rent interest, taxes, rating, material, and water. Long-term investment. Non-current assets which include several types of investment that can take the form of security, provision for fund, and other long-term information. The elements that are included in the long-term investment group are: first, long-term investments in securities such as stock, months and long-term notice. Scott implements in subsidiaries, including long-term advance. Third, implements in tangible fixed asset, or should explain machinery but not yet used for business now. Fourth, provision of fund for long-term purpose should is one to pay off bond, Apprenticeship bond, owns to process bond, pension payment fund, fund building repayment in order. 5. Case surrender from life insurance policies. Tangible asset. Tangible assets, also known as hard asset, are visual items with a clear purchase value used by a business to purchase goods and services. Examples of tangible assets include furniture, computers, and machinery. Business can also have non-physical assets known as intangible assets, such as goodwill, patents, and copyrights. Current vs. fixed assets. Tangible assets can be divided into two groups, fixed and current. Current assets, also known as liquid assets, are either cash or either with a business expected to sell by the end of the financial year. Current assets can be sold to increase cash flow or its debits and other liabilities. So, in an example of a current asset is expected to be sold in the near future. Fixed assets are physical items that cannot easily be sold in any fund usually because these items are considered long-term investment or because they are essential for the day-to-day running of the business. Machinery and property are examples of fixed assets as both are essential in the running of the business so cannot easily be sold. Tangible assets in accounting. Tangible assets are initially recorded on a balance sheet at the original cost. However, they will eventually move onto an income statement through one of two devices. Current assets shall be organized on the balance sheet depending on how easily they can be converted into cash, with the most liquid asset coming highest of the comment. When current assets are used, they become part of the cost of goods. Fixed assets move to the income statement through depreciation in ongoing process. Probably the cost of an asset is recorded as an expense over its useful lifetime. For example, a computer lasts several years before it breaks or becomes outdated. The initial cost is spread out across the predicted useful life of the computer, with some of the costs being recorded in expense every year. Tangible asset in debitor. Debitor invoicing software help you keep track of company assets and monitor their value over time. With debitors' larger price plans, you can enter an asset, then track depreciation over the asset useful lifespan. Just enter the asset in as an expense, mark it as an asset, then turn on depreciation. The debitor help you straight line depreciation to break down the cost of the asset of a set number of years to make it easier to monitor the value of your asset. Intangible fixed asset. Intangible assets include operational assets that lack physical substance. For example, goodwill is a fixed asset as a funded copyright, trademarks, and franchise. Company intangible assets are often not reported on a company financial statement, or they may be reported as significantly less than their actual value. This is because assets are accounted for at their historical cost. Unlike tangible physical assets such as a building or machinery, intangibles are often developed internally without any direct measurable cost that can be capitalized when an intangible is processed. However, or when costs can be directly tracked to the development of the asset, the cost is recorded as an intangible asset on the balance sheet. Intangible asset valuation. Intangible assets are valued at their cost of acquisition. The processed intangible is valued based on the amount paid for the asset. Research and development costs associated with developing an intangible are expensive for the year in which they were incurred. However, costs of registering patented or trademark and legal fees incurred to defend it, a company right of use are included in the cost of acquisition, which is reported as an intangible asset on balance sheet. Intangibles with a determinable life. Intangible assets with a determinable life are amortized over their useful lives. Amortization is a process of allocating the expense over several accounting periods to reflect the actual amount of the asset consumed each period. The useful life of an intangible asset is usually assumed to be the intangible asset legal life, although the useful life will often be shorter. A patent, for example, has an illegal life of 17 years, but its useful life may expire earlier than this if a new invention makes the patent technology obsolete. Intangible with an indefinite life. Many intangible assets have indeterminable life. For instance, there is often no reasonable way to determine how long a company's brand will hold value. For this reason, intangibles with an indefinite life are not amortized but are tested for impairment instead. An impairment expense is recognized or if the asset carrying value exceeds its fair value, a company should test out intangible for impairment at least on each year on the impairment is recognized. Is it not permitted to be recovered? Year is higher on intangible assets. Section 197 of the Internal Revenue Code defines tax accounting procedure for intangible assets such as copyright, goodwill, and trademark. These assets must be amortized over a period of 5 years regardless of their user's life. Section 197 does not permit impairment testing but it may allow you to recognize a loss if the asset is disposed of before it is completely amortized. If you are building a business or a stake in a business, which includes intangible assets as part of the selling price, the intangible can be amortized by the buyer only if it was amortized by the seller and only if the transaction was not part of a seller's contracted transaction. This is known as the intercompany rule designed to ensure an owner does not convert intangible that don't equality for amortization into those that do. Other assets or assets. These are assets that cannot be included in other groups such as deposit to seller to guaranteed contracts. Building involves long-term mutual advance to company available in attacks. Liability and owner equity. Liability are defined as company legal financial debts or obligations that arise during the course of business operation. They can be limited or unlimited liability. Liabilities are still over time through the transfer of economic benefit including money, goods, or supply. The owner equity is simply the owner's share of the asset of business. You see, assets can only belong to two types of people: people outside the business who you owe money to, or debit known in accounting as liabilities, the owner himself or owner equity. Current liabilities. A current liabilities is an obligation that will be due within 1 year of the date of company balance sheet and will record the use of a current asset or will create another current liability. However, if a company's normal operation cycle is longer than 1 year, current liabilities are the obligation that will be due within the operation cycle. Currently, liability are usually referred as a separate section of a company balance sheet. This allows rather to distract the total from the complete total amount of current assets in order to determine a company working capital. Or dividing current assets by the current liabilities is the company current ratio. Example of current liabilities. The following are common examples of current liabilities: accounts payable or trade payables, notes payable that will be due within 1 year, the principal portion of a long-term loan that must be paid within 1 year, wages payable, income taxes payable, interest payable, other accrued expenses payable, deferred revenue and customer deposits. Revenue received in advance. Under the actually basis of accounting, revenue received in advance of being earned are reported as a liability. As the amount received in advance is earned, the liability account shall be debited for the amount earned and a revenue account shall be credited. When a company receives money in advance of earning it, the accounting entry is a debit to the asset cash for the amount received and a credit to the liability account, such as customer advance or funeral revenues. As the amount received in the advance is earned, the liability account shall be debited for the amount earned and a revenues account shall be credited. This is done through an adjusting entry. Example of revenue received in advance. The following are a few examples of revenue received in advance. An insurance company receiving premium for protection during the following 6 months. A magazine publisher receiving money from a subscriber for bargaining for the following year. A basic design company receiving a client's down payment for future work. A law firm receiving a retainer fee from a New Zealand. Long-term liability. A long-term liability is an obligation resulting from a provision even that is not due within 1 year of the date of the balance sheet or not due within a company operation cycle. It is longer than 1 year. Long-term liabilities are also known as non-current liabilities. Example of long-term liabilities. Some examples of long-term liabilities are the non-current version of the following: bonds payable, long-term loans, pension liabilities, post-treatment health care liabilities, deferred compensation, deferred revenues, deferred income taxes, customer deposit. Some long-term debt that will be due within 1 year of the balance sheet date can continue to be repeated as a long-term liability if there is a long-term investment that is sufficient and restricted for the payment of the debt, or intended in a non-callable arrangement that assures that the long-term debt will be repaid with new long-term debt or with capital stock. Other liabilities. Debt that cannot be reported in the title of what are reported under other titles. For example, debts bonds that are due but will be repaid from the bond statement funds, long-term debt to company official or subsidiaries, and other. Debts that may arise due to past activities are called contingent liabilities. Such debts are shown in the balance sheet via footnotes. This includes uncompromised debt, for example, discounted notes, payable, legal defense, taxes, and other expenses is uncertain and the warrants given. Glossary of key terms. Financial statement. Formal record of the financial activities and position of a business, person, or other entity. Statement of cash flow. A financial statement that summarizes the amount of cash and cash equivalents. Balance sheet. A statement of the assets, liabilities, and capital of a business or other organization at a particular point in time, detailing the balance of income and expenditure over the preceding period. Income statement. A report made by company management that show their revenue, expenses, and net income or loss for a period. Asset. A reserve with economic value that an individual, corporation, or country owns or control with the operation that it will provide a future benefit. Liability, an obligation to or something that you owe somebody else. Liabilities are defined as a company legal financial debts. Owner equity. The owner claims to company assets after all of liabilities have been paid off. Question and answer. Based on the article on financial statement, answer to the following question in full. First, what is financial statement? Second, give the example of a financial statement for a company. Third, mention and explain the components of financial statement. Fourth, explain the following: balance sheet, income statement, the statement of cash flow, and retained earnings statement. Fifth, explain the classification of asset and liability and give their example. Sixth, give the example of the balance sheet, the income statement, the statement of cash flow in a company, and give brief explanation. Seventh, summarize the article on financial statement and video record your summary by using YouTube.com and post in Edmodo. Translate the component in this figure into English. First, income statement. Second, balance sheet. Third, statement of cash flow. Grammar focus. Simple past tense. We use the simple past when you talk about something we started and finished in the past. We use the simple past to describe a series of actions in the past. We use the simple past alright together with the past progressive order. The action in the simple past interpreted the action in the past progressive, or the one big waste in police. How do we form the simple past? We form the simple past with regular verb, infinitive plus ed, with irregular verb, second column of the table of the irregular verb, affirmative sentence in the simple past, regular verb. I played with a ball, you played with a ball, he played with a ball, she played with a ball, it played with a ball, we played with a ball, you played with a ball, they played with a ball. Affirmative sentence in the simple past, irregular verb. I went home, you went home, he went home, she went home. Negative sentence in the simple past, regular verbs. I did not play with a ball, you did not play with a ball, he did not play with a ball, she did not play with a ball, it did not play with a ball, we did not play with a ball, you did not play with a ball, they did not play with a ball. Negative sentence in the simple past, regular verb. I did not go home, you did not go home, he did not go home, she did not go home, it did not go home, we did not go home, you did not go home, they did not go home. Use the auxiliary did or simple past of do every time regardless the subject. Grammar exercise. Exercise 1. Name that grammar worksheet or story order. Past tense. Complete the paragraph below by filling in the missing words. Be sure to change the verb to past tense. Forget, go, look for, we, say, is not, is, fine, turn on, drive, put, look at. Something terrible happens to me last week. On Monday, I booked a lottery ticket at a shopping mall near my home. I blah 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 the ticket in the pocket of my jacket and blah 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 home. After I got home, I went to bed and blah 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 about the ticket. On Tuesday morning, I got into my car and blah 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 to work. On the way to work, I blah 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 the radio and a man on the radio said my lottery ticket number. After he blah 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 my number, I put my hand into my jacket pocket. Oh no, the ticket blah 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 in my pocket. Next, I drove back home and blah 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 the ticket. I blah 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 the ticket. It was on a table finally. I blah 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 the ticket very carefully. Oh no, I cannot believe my eyes. It blah 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 the wrong number. Next time I will be more careful. Maybe next time I won't buy a lottery ticket. Exercise 2. Simple past. E. Put the verb in brackets into the past tense. First, my brother and I blah 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 played tennis yesterday. Second, I blah 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 used the computer to email my friend. Third, John blah 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 enjoyed going to the park. Fourth, he lost his wallet so he blah blah called the police. 5. Our class blah 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 studied hard for the test. 6. The car blah 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 stopped at the traffic lights. 7. Cat and I blah 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 talked for 3 hours on Saturday. Eggs. Can blah blah blah. Watch TV for 5 hours last night. Ninth day. Blah blah blah. Walk to school today. Tenth. He was bored, so he blah 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 listened to music. B. Make the sentence below negative. Example: I enjoyed the show. Change: I did not enjoy the show. Fear: Ted wanted a bike for his birthday. Second: we helped our mother cook dinner. Third: I played basketball on Tuesday. Fourth: my mother walked to the supermarket. How works? Open the following link and explain what is discussed in the videos of accounting. Video record your explanation in 150 words by means of www.youtube.com. Post the links of your video in a demo. Here are the links the most often. Thank you.